Welcome back, traders. My name is Manuel Fonseca. Welcome to Smart Habits. In today's video, we're going to see a theoretical video about market structure rules you must follow, not exceptions. Here's no exceptions about this, okay? This is a complement about my first video of the channel, which is a simplified market structure video, which if you would like to see it more with the examples of the market, I kindly suggest you to watch it, right? But this is just theoretical information, but it's actually very, very important. So I'm gonna let you know some important things about this, so you understand more why this is that important. So market structure comes first. This is the most important thing. So the market structure defines the direction, and this is the key thing. Before any order block, liquidity, or entry confirmations, you must know where the price is coming from and where the price is likely going, right? So I explained that there is some supply demand areas, but let's say in few words, you need to understand why the price having a reaction in this bottom, for example, why it have this reaction, and then why the prices keep pushing up. So imagine, right, that you understand the market is reacting here in an order block or a certain reaction, then you will be expecting likely to the price keep pushing up or going up, right? So with that structure, everything else is noise, right? So if you don't understand where the price is likely to go, the patterns, setups, liquidity, order blocks, confirmations, indicators, whatever you see won't work, all right? So the most common mistake about this structure is that traders see structure instead of defining it. And most traders change bias candle by candle, confuse pullbacks with reversals, and trade based on hook noted rules. So as I said before, I'm not going to explain this in this video, but in the simplified market structure video, I define when is something a reversal, likely to become a reversal, when something is just a retracement, which is part of the natural movement of the market, right? So when you have that set of rules to define the correct direction, structure must be an objective. Simple as that, right? Now, I'm gonna give you a set of rules to understand it briefly, let's say. So rule number one, start from higher time frame. So the direction defined is okay, sorry. The direction is defined top down, always. So to refine the structure on a higher time frame, use lower time frames only for execution. So you never define bias from the execution time frame. Never ever. Right. So if you're the type of trader that just you say, I'm just gonna execute orders in 15 minutes time frame, but you never watch, for example, the 4 hour time frame or the 1 hour time frame at least, you will be in that horrible situation of executing multiple orders, counter trend, and that it's actually very horrible, right? So once you define the bias from the execution time frame, excuse me. So once you have the higher time frame, it will give you that context. Once you have the context, which means where is the price likely to move, lower time frame will give you that precision to secure your order, right? The rule number two is structure requires confirmations. It's not just like you see impulse, and because that impulse, then you're ready, say it's bullish or bearish. No, no, no. One candle does not change the structure. Understand this, friends. Valid structure change require a clear break, a confirmed close, and respect of the previous highs or lows. So as an example here, I'm just gonna draw a little bit of the theory I explained in previous videos. But to define a beginning of a range or the ending of a range in the smart money concept framework of theory, you first will need something that is called a swing high, which is like a high, normal high, and a low. After that low, you would need a take of liquidity. So the price will push down a little bit more, right? So the price took the liquidity of these lows, and then the price will need a boss, which is a break of structure. So once you got the boss, and sorry for the horrible drawing, that's why I recommend you to watch the other video. You will have the next, which is the confirmation of a beginning of a range. Let's imagine that we're in a bullish trend, right? So once you got this information, you have a clear break, a confirmed close of the candle, which makes a and the respect of the previous highs or lows. In this case, it took the liquidity of the lows and keep pushing. Then you think that the price is likely to keep pushing up. So with that information, then you will have a bias of the direction you are intending to. Now the rule number 3 is pullbacks are not reversals. All right. So most traders lose in a trend. Pullbacks are expected, definitely, and liquidity is taken. Now the structure remains intact. What is that thing that I define as a pullback? If you see this example that is here in this, we're gonna imagine that we are in a bullish trend. Imagine that the price is going pushing up and gets to this, and there you go. So you see this move, and you start thinking, all right, this is bullish. So people that start seeing these movements that I'm highlighting here, and these are called the reversals. So some people, when they start seeing these reversals, they think those are confirmations to execute selling orders. So people start putting selling orders because here is a double top or a triple top. So they put orders to sell, but they have forgotten the main trend, which is bullish, right? So this is what it says: structure remains in. There will be reversals, which they are expected. These are reversals. The main trend line is bullish. So that's why the price make this confuse some people, and it keep pushing up, even make and more. But in a certain point, it just keep pushing and respecting the main structure, which is so until the structure is broken and confirmed, the trend is still valid. All right, unless you find end of a range or a market, then you won't be able, or there will be a low to think about. But for that, again, I recommend you my video about the structure. Now, the rule number 4 is not a structure equals not period. Not trading is not trading is a valid decision. All right. If arranging praise, arranging choppy movements, not clear highs and lows, or simply you cannot not understand the chart or the pair you're trying to this, you should stay out. Simple as that, right? Professional traders avoid the market is completely uncertain, right? But you need to define the rules that give you that certainty. And if in the market you're watching or analyzing, it's not clear for you, do not execute any order there, right? Otherwise, you're risking your money, your emotions, and especially your confidence. Now, the rule number 5 is structure comes before anything, right? So noise. So order block exists, liquidity is present, but the structure is unclear. You simply do not trade, right? It's like in the previous example, withdraw there, but withdraw here, right? You need to understand the main and know if you understand that the trend is bullish, then just execute setups that are bullish, not the ones who are selling, right? Selling unless you're advanced enough to understand why or where you're doing it. This is the paramount. Define the main structure. Once you got this, you will be like there will be more chances to have outcomes from this type of this is the disciplined trading mindset, disciplined trader mindset. That the rules protect you from not from the market, from you own, right? So structure rules, create consistency, reduce over trading, and remove emotional bias. Something that we need to do on our own, right? There's no strategy or method that will help you with that unless they are like there, like coaching you until you can do it, right? But at the end, my friend, coach, professor, and you should be aware of all of these things, right? Breaking rules feels good, but following rules builds longevity on this important profession. I'm just gonna put a small example. And if you know how to ride a bicycle, imagine that your dad or a friend of you or someone teach you how to do it, right? They give you like steps to start riding the bike, right? Like, oh, you need to have a little bit of impulse. Remember that you just need to use the pedals, push it down or forwards, right? And in front of you because maybe you can crash. And let's say you do the first 3 or 4 steps and you forget to up front of you, and then you crash with a tree, or you just fell down, it's because you didn't follow the rules. Then you just wake up, do it again, and that's you start creating that habit. It's the same thing. When you realize you're on your own, there's no one protecting you, helping you to maintain the equilibrium or the balance of the bike. Then you say, and you think, all the decisions I'm gonna execute will lead me to a result that I will be crashing or falling down, or actually riding this bike properly and in moment. It's the same. So you need to do this on your own, and then you will understand much, much and more, because you are the one who created. And in a nutshell, my friend, market structure is not optional. This is important, right? And if you want consistency, respect your structure, create less, and execute. So if you like this information, subscribe for mentorship, for style, for smart money concepts to this channel, because I will keep posting more videos about this. And my friends, there's a lot of videos about the smart money concept if you don't have a clear strategy to follow. Also, I suggest you to the ebook that is in the here, and it's a simplified method of the smart money. Remember, before you go, my friends, you have any further questions, write them here in the comments, revise this presentation and this video if you need, and leave a comment again or share it with a friend that you think is in this path and he wants to improve and be better every day. Okay, so thanks so much for coming and watching this video, and I see good